Welcome back to Morning Trade Live. We've got futures bid here. Equity markets trying to start the week off on the right foot and better momentum. And bulls looking for it to come back into play here. Joining us to talk about the week ahead and more, Eli Pars is the Co-Chief Investment Officer at Calamos Investments. We got a big week ahead of us here. Eli, thanks for joining us on the Schwab Network.
Yeah, thanks for having me. Good morning.
We got an FOMC that 3 months ago had interest rate cuts priced into it, and of course now close to a 0% chance, but markets have been doing just fine anyway. Do you expect any of that to change anytime soon?
You know, I think the market's been talking about the Fed cutting rates in 6 months for 18 months, and it just keeps sliding out, and I think we're probably going to see more of that. But the resiliency of the market has been impressive, and the economy to a certain extent as well. 500 basis points plus of rate increase is, something we haven't seen very often in the U.S. economy. And to think that the only thing that broke was Silicon Valley Bank was pretty surprising.
Yeah, the one big pothole we had didn't derail the car, I guess. And so far, it seems like it's been kind of isolated out. Do you guys have any, should we as investors have any major risk points in front of us, or is this now just kind of a pretty straightforward analyzing a cycle, how hard we land, etc.?
It gets down to an individual investor's risk appetite, right? I mean, this has been an aggressive move over the last year in certain big tech names. You've been talking about NVIDIA this morning. Obviously, their business is hitting on all cylinders. But it's more speculative things like Bitcoin have been up a lot too. So there's clearly a lot of euphoria in the market. To the extent investors want to hedge some of that, I think there's some interesting things in the option market that haven't been there in prior years.
Where do you see the most interest in your products? Calamos, as it's grown over the years, offers just about everything one can imagine: mutual funds, closed ends, ETFs. Where do you see the most interest? So what are the most relevant products that your investors are buying?
The biggest one for us is our largest fund, the Market Neutral Income Fund. It's about a $14 billion fund with bonds once again down year to date, and we're up, 1.5%, 2%. We're up 9% last year. It fits pretty well for a lot of people.
So this is, and we're looking at some of the construction of this at the end of last year versus the year prior. You're not going to see traditional fixed income from a bond standpoint. You're creating fixed income like properties mostly through equities?
Well, mostly through half is equities, half is a hedged equity strategy where we're essentially long the S&P 500 through individual stocks, but economically we're basically long the index and trading index options on top of it, selling calls, using a portion of that income to buy puts and a portion of it as income for the portfolio. And then the other half is arbitrage strategies, mainly convertible arbitrage, where we're buying convertible bonds and shorting their underlying stock. Names that have been big in the convertible market in the past include NVIDIA and Tesla.
And what does that mean for you? Because, correct me if I'm wrong, you're not directionally long the plays that you're arbitraging the convertible debt, but I mean, if the better they're doing, the more debt they issue, then I would guess the more opportunity you have to arbs. How does that play out?
Yeah, we're long volatility, so we want to see the stock move around. So things like the S&P 500 event are good for us. It gives us an opportunity to trade the stock. Stock goes up, we sell some to get heavier in our delta, to get more in line with an economically neutral delta. And then the stock pulls back a little bit, we buy it right back. You're mechanically selling high and buying low and generating return from that. It's a lot of, we used to say singles and doubles, and we've kind of evolved to singles and walks. But you try to have a lot of 70-80% of your trades be winning trades and earning a return over time.
What is the genesis of it? Why is it the one that you're putting most in front of investors? Are they still looking for bond replacement? Is there still an idea here that if we're in an inflationary environment, treasuries are not going to be as safe as a ballast in the portfolio?
I think it's still, fixed income still tough, right? Rates are, the yield curve doesn't look like, what I would call a normal yield curve. You think back 20 years ago and overnight money was here at 5%, but, the 5 and 10 year and 30 year were all higher than overnight money. It was a positively sloped curve. We haven't had that for a while. And, at some point, the bond market and the stock market are going to say the same things, but they haven't for a while. So I think it makes sense to think about how you diversify your fixed income allocation. It doesn't mean you're not going to own any fixed income, but at the margin, you may want to look at alternatives.
Right now, the 60-40 portfolio is coming off a pretty good recovery period. Is there an implicit, when you're talking about having this fund in the portfolio, is there sort of an implicit opportunity cost short of treasuries? Is the idea here that duration doesn't look too appealing through treasury bonds?
Well, and for us, we're not really playing duration, either way. We're not long it or short it. A lot of the arbitrage side of the fund, and to a certain extent the hedged equity side, the option market side, is linked to overnight money. So in the convertible arbitrage side, the coupons that new converts have reset. They're typically converts are 5-year paper, so pretty short. And the rebate we get on our short positions is directly linked to overnight money. So we're more focused on the short end of the curve. And the option market, you've seen, just like, Black-Scholes model predicts, and, the risk-free rate is a component in option pricing. And you're seeing trades that, you had to pay to put on 3 years ago. Now you're getting paid to put them on. And that, it's really a function of the rise in overnight rates.
So the rate situation certainly doesn't hurt it then if that kind of creates this opportunity to harvest more premium. What about for volatility right now? Is that in a place where it's advantageous to you? Is the risk that then volatility subsides and you don't get as much premium in the options that you're using? Is that kind of one of the downside cases?
Well, definitely your returns are linked a little bit to overnight money. So if overnight money would go back to 1 or 2%, our expected returns would be lower. Still a spread to overnight money, but for now, with rates where they're at, we've been able to earn higher returns than we had in prior years because the strategies do have a linkage to overnight money and do generate a spread to it. So.
Okay.
Overall, we think it's a good, interesting time for it.
Understood. And do people use it as like a full replacement of their bond chunk of the portfolio? They dabble into it. Do you use it as an alternative, or does it fall pretty clearly under fixed income?
I use it as my main fixed income part of my fixed income allocation, but I think most of our investors use it as part of a model. They might have 5 or 10 or 15% of their investors funds in the market neutral income fund, but they have some other, either bonds or bond alternatives in their book.
Got it. Last thought here, Eli, is when you look at volatility right now, just kind of generally in the market, we got a VIX just shy of 15. Given where rates are, given what you see, is that low vol? Is that a high vol? Where do you think we're appropriately priced for volatility right now?
It's definitely reasonable, and it's cheaper to hedge than it's been for a while. You got to look at the realized vol has been like 11, 12. So we haven't. You see it just looking at the market over the last month. It's just been kind of sideways, and even looking at intraday vol, it's still is still relatively low. So I'm not sure you're going to make a lot of money if you go out and buy a bunch of S&P options and hedge them up and try to make money scalping the volatility. But I think if you're a long-term investor and you're looking to smooth out the ride, either on your own or through hedged equity products, it's an interesting conversation.
All right. Very interesting conversation. Thanks for the details on the fund and what you see in the macro landscape. Appreciate your time, Eli.
Thanks for having me.
Absolutely. Really good stuff. CMNIX. All right. The fund to replace some of the bond allocation in the portfolio.